Good morning and welcome to Financial Accounting. This is day 4, the end of week 2 already. And as usual, I like to start with what we're doing today, what's coming up, just as a reminder to you. I know I mentioned in class on Tuesday, but it is important to keep in mind that when you're looking in Brightspace at this work to do section, that once you click on one of those assignments, it takes it off the work to do because it thinks you've completed it, and that is not necessarily the case. So although hopefully I'll be able to use it during class at the beginning to remind you of what's coming up, I don't want you to be too attached to this because it does not necessarily reflect where you are as far as what you've completed. So you will want to keep track in Brightspace, or excuse me, not Brightspace, in Cengage, in CNow, if you can see in your grade book the items that have been submitted for grading. You can also tell if you're just looking at the assignments page that something is done because it no longer will allow you to access it. It's showing you that it's completed. And so please just keep track of that. I will be doing the same thing. As I look in the grade book in CNow, I will, if I see that you are working on 4 different assignments that you haven't submitted, I'll probably just send you a note and say, if you're done with those, please make sure you submit. Another way to tell is the grade book in Brightspace should only show the grades for the items that you've submitted for grading, not ones that you've started and haven't completed. So please keep track of that. Remember, you do have flexibility with the due dates, but it is important to stay on track because we have 50 some due dates throughout the course of the semester. That's about 3 a week, a little bit more than 3 a week. And so it is important that you stay on track. You can't just jump in the middle of chapter 6 if you haven't done the earlier chapters. So where we are today, we are starting chapter 2. And so the chapter 2 pre-quiz should be submitted in CNow by the end of the day to be on track with those due dates. Remember, on those pre-quizzes, you need to score a 60% or higher. I did notice yesterday, the day before, a couple people had submitted quizzes that were then marked as failed because they hadn't reached that 60%. So I did reopen a couple people's quizzes, and I can't remember exactly who that was. I have about 56 financial accounting students right now. And so I don't remember whose I reopened, but if you know that you didn't get credit for that, or if you are in CNow and notice that the quiz is showing is not submitted, that may be why. If you think you submitted it, maybe that I just reopened it to give you another chance. Early in the semester, people might not yet have a sense of how that works. So again, you need to get a 60% or higher to get credit for that. If you get anything less than 60%, you get no credit. Even if you have 59%, that's no credit. Also today, you should have chosen a company for your annual report project and posted that to the discussion board. When I looked this morning, I think about 20 people had already chosen companies from what I saw. So that means a small number, single digits, have not yet chosen a company. So please make sure you do that. When I looked yesterday, I think there may have been, although it may have been my other financial accounting class, there was at least one company that was chosen by more than one person. So do remember, please, to scroll down through everyone's postings before you post your own company. Make sure that someone has not already chosen that company. If more than one person chooses the same company, whoever posted first is the one who will be allowed to do that. And whoever posted after that will be asked to choose a new company, or I will assign them to you. The other item that's due today, but you can't see on this work to do because must be I clicked on it at one point, is the chapter 1 problem. So that problem is done outside of class. As I've explained in earlier classes, I am happy to answer questions or help you with that as needed, but we do not go over it in class. Once the problem is due, you can see the answers and, once you submit it, you can see the correct answers and what you answered. Of course, if there's something there that doesn't make sense to you, you don't understand why your answer is not correct, you just need to ask. I'm happy to go over that during office hours or in a separately scheduled appointment, whatever works for you. So again, by the end of the day today, you should have completed all 3 assignments for chapter 1, pre-quiz, which was due last week, exercises, which were due Tuesday, and then the problem due today. And we're going to be starting with chapter 2 today. So if you have not already, please go ahead and log in to See Now and open up those chapter 2 exercises. We'll be getting to those pretty quickly here. Is there any questions you have at this point from chapter 1 or anything else we've talked about so far? Okay. Don't hesitate to ask. You can ask outside of class, send me an email, schedule time with me, whatever you need to do. Chapter 1 and 2 and 3 are just the foundation of everything else we do. So it's very important that you get that good foundation to build on in the future chapters. I'll put this in the announcement after class, of course. Oh, and I do have a question about that. So I will put this in the announcement, but remember that next week I will not be available. So there will be no formal class. You don't need to come to this classroom on Tuesday or Thursday. If you want to stay on your regular routine, if you don't have good internet access from home or wherever, you are certainly welcome to come use the classroom to do class. Your class assignment will be detailed in the announcements or the announcement that comes out after class, but we will stay right on track with the syllabus, which means Tuesday, the expectation is that you're finishing up chapter 2, and then Thursday, you're starting chapter 3. Excuse me. There are videos, as you already know, there are videos posted already in the reference materials folder. Those videos for next week will be the ones from spring, so I won't be redoing new videos. The exercises are the same. If there are any differences, I will let you know in the announcement. But keep in mind that the spring class was still using the 15th edition. We're now using the 16th edition. So some of the exercises, although the exercise itself is the same, the numbers in the assignment might be different. And again, I'll put that into the announcement so that you're very aware, hey, exercise 4 is in the video, but you'll need to redo some calculations potentially for different values included in that exercise. So for that reason, because I won't be here to finish up chapter 2 with you on Tuesday, I would like to move as quickly as we can without glossing over material, without confusing people today, to make sure we can cover as much of it as possible together in class. What I wanted to ask about was the announcements. So as you know, as you can see here, I do post announcements in Brightspace every day after class telling you, here's what we did. My question is this. In Blackboard, which is the learning management system we used prior to this semester, as many of you probably know. In Blackboard, when you posted an announcement, it then went to all of the students in the class as an email to your JCC email. Brightspace doesn't work that way. So my question is this. I can also send the announcements as an email if people would find that more useful than having to log into Brightspace to see the announcements. Is there anyone who thinks that would be better to have them come as an email?
Yeah, I do too.
You do?
Yeah, I
Well,
just
why
had
did
to
they-
change my notification settings around. I got it.
Well, why are they telling me that it doesn't work that way?
I got all yours from
Okay.
like last year.
Yeah, same.
Okay,
There was like 900 of them.
in your email,
Oh, I didn't
when I,
get that.
just because I copied the class. Interesting. Okay, well, ignore that then. That is definitely not the message that we are getting, and obviously I'm not a student, so I can't see it. They absolutely told us that we had to set, that it did not come. So maybe it's a global setting that we can set individually, and some
There's also
instructors don't have it set. An app for them. Mhm. Good to know. Okay, forget I asked that question. I'm glad, my intent is to have them come as emails, because I know not everyone checks your email diligently. But at least that's just one more place that you're getting that information. So, okay. Good deal. And I apologize for flooding your inbox at the beginning of the semester. That's part of copying the course, so it's kind of interesting. Any questions, anything you want to talk about before we start chapter 2? Okay, let's get going with chapter 2 then. As you can see, chapter 2 is about analyzing transactions. So in chapter 1, we learned what a transaction was. That is anything that affects the financial position of our company. If it is a transaction, we need to record it in our accounting records. And we already started a discussion on Tuesday about how it gets recorded. So we already know that it gets recorded in the accounts, that every transaction must affect at least 2 accounts. But what we're going to be focusing on for this chapter is how do we actually record it? So we recognize, hey, this is a transaction, we need to put it in our books. What do we put in our books, and what does it look like? How do we actually accomplish that? So as always, we have a series of learning objectives, and the chapter is organized around these learning objectives. For this chapter, we will be going through basically one at a time. So we'll start out with what accounts are, and how do companies decide which accounts they're using? How do they know what accounts they have? And then we will get into actually recording or analyzing transactions. And we'll talk about the 3 questions that need to be answered for every transaction that we need to recognize. How do we get that into our books? How do we get it into the individual accounts? And then what if we make a mistake? How do we recognize that there is an error, and how do we fix that error? So an account is the smallest unit of storage. All the transactions that affect an account are going to have something in common. So for example, we have an account called cash, we have an account called equipment, possibly, an account called accounts receivable, accounts payable, inventory. And so everything that affects that account is, if it affects the inventory account, we know that we either have more inventory than we had before, or we have less than we had before. We're making a change to that account when we record a transaction. So our accounts have 3 parts to them, and we're going to be using something called a T account as kind of a shorthand or scratch pad way of recording, of looking at how do these transactions affect these accounts. The accounts have 3 parts then. I'm going to draw a T account on the screen just so you can see what these 3 parts look like. So it's called a T account because it looks just like a T. And on the top of the T, we write the title of the account. The title of the account should be short and simple and to the point, but it should include enough information that anyone looking at it would know what what that account is used for. So we talked last class about supplies versus supplies expense. So supplies is the asset that represents the value of the materials that we have to run our business. And supplies expense represents the value of the supplies that we used up in the running of our business. So we put the title on the top of the T, and then we have two other sides. We have the left-hand side and the right-hand side. We have the left side and the right side. But we can't make it that simple. I don't know why. But in accounting, we do not call it the left side, we call it the debit side. And we do not call it the right side, we call it the credit side. So we have the left or the debit side and the right or the credit side. To make it even a little bit more complicated, we abbreviate them. And we abbreviate them DR and CR. I will tell you, I worked as an accountant for years and used those abbreviations, and never once did it occur to me what I'm about to tell you. So if you're already looking at this going, boy, that looks kind of weird, you're way ahead of me, even though I worked as an accountant. Does anyone see something really weird? Debit doesn't have an R. I never ever wondered why we would abbreviate debit as DR when it doesn't have an R in it. I think it appealed to that part of my brain that just likes things to be neat and orderly. Maybe that's why I became an accountant in the first place. And I like that it just matched the CR, so it's kind of balanced. But good for you for realizing that, because I never recognized it until I started teaching accounting, and I'm like, oh wait, that's kind of odd. So the reason we abbreviate it that way is not for people like me who just like things to be orderly and balanced. They're abbreviated that way because there are the abbreviations for the Latin terms, because accounting was developed by a monk 500 something years ago. Luca Pacioli developed the concept of double entry accounting, and that's what we still use today, is very much the system that he set up. And because he was a monk, he worked in Latin, and so he used the Latin terms for debit and credit, and we use the abbreviation of the Latin terms, which you do actually have the DR, the R in there. So trivia, fiction and fact. So you'll notice I didn't tell you yet which side of the account increases and which side decreases the account. And the reason I haven't said that yet is which side is used to increase or decrease the account depends on what type of account it is in the first place. Excuse me. I'm going to clear that drawing so I can move on to the next slide. Okay. I'm skipping through this just for a moment. We'll be talking about that, what I just skipped through. So we know that accounts are the smallest unit of storage in our accounting records. Every company has a list of all of the accounts that have been or are currently used in their business, and that is referred to as the chart of accounts. It's just a listing of accounts. The accounts in that chart of accounts are listed in a very specific order, and they are listed in the same order as they appear in that fundamental accounting equation that we learned last week. So it starts with assets, then liabilities, then the permanent equity accounts. So that's for now, common stock and retained earnings, and then dividends, then the other temporary accounts, revenues and expenses. So again, they're listed in that same order that we've been using with that fundamental accounting equation expanded. And they should be listed, they must be listed in that order to be correct. So how do we keep them in that order? Well, for virtually all accounting systems, your accounts have numbers. They're numbered accounts, and how many numbers are in the account number totally depends on your system. So one of the companies where I worked, our accounts actually had 8 numbers to them because we were a couple corporations under one big umbrella. So the first 4 digits represented the account, and the second 4 digits represented the corporation that that account belonged to. For our purposes in class, if we are looking at account numbers at all, which won't be very often, but if we're looking at account numbers at all, we will probably be using ones with just 3 digits. The account numbers at JCC are actually, I think they're also 8 digits. And the second 4 digits refer to the department that you belong to. So how do we keep them in order? Well, assets need to be first. So in general, the assets are going to start with the number 1. Liabilities need to be next. And so in general, liabilities would start with a number 2 and so on. So if we put them in numerical order, based on the rules, based on the order of that fundamental accounting equation, the chart of accounts will stay in order and all the assets will be grouped together in 1s and then liabilities in 2s and so on. Within the assets, there is also a predictable order, and we did talk about this last class. Assets should be listed from most to least liquid. So the ones that are closest to being cash are going to be listed early on, and the ones that we're going to have around for a longer period of time, things like buildings and land and equipment, are going to have a higher number. They're going to be listed later, so they might be like the 1/8 or the 1/9. We've already talked about that. So here's an example of a chart of accounts that goes in the order that I've already mentioned. Assets starting with 1s, then liabilities, equity. The permanent equity accounts come first, along with dividends, and then revenues and expenses are at the end. Most of the time, we would not include just sequential numbers. So we wouldn't start with number 1 or number 11 and then go 12, 13, 14, 15, 16, 17, 18. We'd leave space in there, knowing that in the future, if our business changes, we may need to add some additional accounts. And so things like land and office equipment, you can see under the assets, we did skip a couple numbers in there. Now they're working with a 2-digit system here. There's not a lot of room to skip numbers. But you can see even under the liabilities that they did skip numbers there. The equity, they didn't. And I would suggest that was probably not the best plan. Yes. Good question. So we'll, and I think. Yeah, so if you can just hang on to that question for about 2 minutes, it's going to come up in our first exercise. So that's a very good question. Why is a prepaid expense showing up as an asset? So I had told you last class that expenses should include the word expense, and revenues typically would include the word revenue. But there are about 2 different kind of exceptions to the rule where you would include possibly the word revenue or an expense where it's not. I don't want you to be confused by that, but if you hold off on that question for a minute, we're going to see that as an example. So as I said, the rules of, we have the debit side and the credit side of the accounts, and which side of the account is used to increase it depends completely on what type of account it is. And so it's very important that we can recognize accounts. We look at the account title and we know, oh, it's this. So let's go to that first exercise and see if we can answer that question. So I had asked you to to log into See Now, and hopefully everyone has the chapter 2 exercises open. In this first exercise, we're not going to do this entire exercise together in the interest of maximizing the use of our time today, but I am going to go over a couple of them because they are like the question that was just asked about prepaid expenses, because they're things we haven't encountered yet. So the left-hand column here, and this is for Delta Airlines, these are accounts that appeared in their financial statements. And so we have to answer 2 questions. And I'm going to start with the type of account and then answer the financial statement question, because to me, you can't answer which financial statement until you know which type of account. So if I had made this exercise, I would have flip-flopped those 2 columns, and we will do them in the other order. Let's look at accounts payable. That's an account title that we have seen before. We've talked about it. What type of account is accounts payable, or any time you see that word payable? I think I heard somebody say it's a liability. Payable means we owe someone outside the company and we will pay them later. It's payable. Maybe it's payable next week or next month or next year, but it's something we owe and we will pay it later. Because it's a liability, which financial statement would you expect to include accounts payable? Balance sheet. Yep. Balance sheet. Now, they've made this easy for us on some of them, recognizing that, hey, not everyone's as familiar with how an airline runs, or, specifically Delta Airlines. I mentioned in class last time that we can't possibly in class discuss every single possible account title that any company in the entire world would use. So we tend to use the ones that are most common, most widely used, like cash and accounts payable and inventory. So for Delta Airlines, they recognize that some of these account titles might not have meaning for us. We might not look at it and say, oh, I know what that is. And so they've already identified for us that a number of these are expenses. It says expense right in the parentheses. And because that aircraft fuel represents the expense, which financial statement would include that account? Income statement, thank you. So any that say expense, are going to be income statement. Let's just skip down here to frequent flyer. It says these are the obligations the company has. So what that means is the frequent flyer miles have accumulated and they now owe something to those frequent flyer members, either free flights or upgrades to first class or business class or whatever. And so the frequent flyer miles that their members have accumulated represent an obligation of the company to provide something in the future. And what does that sound like? A liability, good. And because it's a liability, it would belong on the balance sheet. Thank you. We've got a couple inventories in there. Inventory represents something that they have available to use in the future as they're running their business. And so that would be what type of account? An asset. And because it's an asset, it appears on the balance sheet. Okay, and here's the one that Patty had asked about, prepaid expenses, and that's the one I wanted, the last one I want to talk about from this exercise. So prepaid expenses, why is that not an expense? That's kind of the expanded, you asked, I think, about prepaid insurance or something specifically. So why is prepaid expense not an expense? Well, I'm going to tell you right now that it is an asset, and that's what the question actually was. Why do they have that listed as an asset, but it says expense? What's that?
Because they already paid it.
Okay, yeah, so that's part of it. So they. Okay. So they've already paid for it, but the other part is they haven't used it yet. So they paid in advance. That's the prepaid part. We're gonna spend more time talking about this in chapter 3, but this is a really good kind of introduction to what we'll be doing in chapter 3 next week, starting next week. So prepaid expenses, the ones we typically think of are prepaid insurance or prepaid rent. So think about what this would look like. When we prepare our financial statements, we are doing that because people are going to look at them and make decisions about our company. And so we want them to accurately or fairly or faithfully represent what's happening in our company. Well, let's say we have a store and we sign a 6-month lease on the store, and the owner, the landlord, says, you know what, if you pay the whole 6 months up front, we'll give you a discount. And so we say, that sounds good. We have the cash. We'll pay the 6 months worth of rent or lease payments up front. What do we have now? We have the right to use that store over the next 6 months, over the term of the lease. If we recorded that whole 6 months worth of rent payments on just that 1 month income statement, it's going to make us look like we didn't do very well that month, right? Because we have just 1 month worth of revenues or earnings from what we charged our customers, and we're showing 6 months worth of expense for rent. And then over the next 5 months, we're showing that month's revenues and no expense for rent of the store. And so through the accounting techniques that we're going to learn in chapter 3 called adjusting the accounts, what we do is when we make that rent payment for the 6 months, we record that as an asset. It is an asset for us. We now have the right to use that store to run our business, to sell stuff to our customers for 6 months. It's going to help us over a long period of time, relatively long period of time. Okay. So we record it as an asset, and then each month we make an adjustment. Again, that's the whole point of chapter 3. We make an adjustment to say, okay, how much of that rent was for this month? And we move that off the balance sheet because we just used up that 1 month worth of rental space, and we move it onto the income statement as an expense. So just to put numbers on it, if this helps you, if we have $600, it's really cheap rent. I don't know, maybe it's a tiny little kiosk. I don't know. But let's say we paid $600 because the numbers are nice and neat that way for the 6 months worth of rent. So we have a $600 asset at the time we pay that rental bill. And each month we move $100 of that off the balance sheet and onto the income statement. So at the end of the first month, we only have $500 worth of prepaid rent left. And our income statement shows $100 in rent expense. The next month, we move another $100. So our asset is down to $400 in prepaid rent, and our income statement for that month shows $100 in rent expense. We do that every month. So by the end of the 6 month period, the lease term, our asset is down to 0. And each of those 6 months, we've recorded 1/6 or $100 in rent expense. So Patty, does that help answer your question about why it's an asset? Yeah, I wish it didn't include that word expense. And in general, if we call it prepaid rent or prepaid insurance, we can avoid using that expenses term. They've done that here because they've lumped some together. So prepaid expenses are an asset, and because they're an asset, they would appear on the balance sheet. So you should be able to answer all the rest of those on your own. I'm going to go ahead and click the check my work button. And just to make a note for yourself to come back and finish up whatever you haven't done on that exercise at this point. And we're going to move on to the next exercise. To do that, to do that, I want to show you something. In our Brightspace class, you're very aware at this point that there are reference materials. And why are you not? There it is. Okay. You're very aware that we have this reference materials folder, and many of the items that are in there are by chapter. So I would need to scroll down to see what's in the chapter 1 folder, the chapter 2 folder, and so on. But what I want to show you right now is this accounting equation expanded with normal balances. This is so important that I have it up on the top level. It's not in a specific chapter folder. Then I want to put it in the chapter 2 folder because you'll want to continually refer to this throughout the semester. I'm going to pull that up. Whoops, I'm going to try to make that as big as possible. There we go. So this is a snip that I took out of an older book that is no longer in use. It did not come from the same Warren textbook. And I wanted to continue to use this. The same concept is in our book, but I just think this makes it neater. I think in our book, they kind of have it split on 2 lines and it's a little harder to see. I would encourage you to kind of bookmark this. There is in Brightspace the opportunity to bookmark it, so you can click right there and add the bookmark so that you can easily navigate back to this. But it's in the reference materials folder right at the top. What you'll notice is it includes across the top the expanded fundamental accounting equation. So we know that assets, liabilities, equity, retained earnings, those are all the permanent accounts, the balance sheet accounts. And the remaining 3 dividends, revenues, and expenses are all the temporary or nominal accounts. Those get closed out at the end of the month. And in a couple weeks, we'll learn how to do that. Each one of these then has a T account, and they have the debit and the credit side labeled just as I did on the Zoom screen a couple minutes ago. The part that I did not show you yet is the plus and minus. So you'll notice each one of these accounts has a plus on one side and a minus on the other side. But it's not always the left side with the plus. It's not always the right side with the minus. Those pluses and minuses indicate which side of the account you use to increase it. And so, as I said, I would encourage you to just keep referring back to this. You have to know how to do what we were just doing in that first exercise, which is look at an account title and recognize, oh, it's an asset, or it's a liability, or it's an expense, or it's a revenue. And then once you know that, you can come to this chart and say, oh, it's a revenue. I can see the plus sign is on the right-hand side or the credit side. And so revenues increase by recording the number on the credit or the right-hand side of the account. Make sense? I do not expect you to memorize this. I will give you the best I can do as far as how am I supposed to remember this. But refer back to it as often as needed. As I have already said in class, everything is open book. So there's no reason that you can't refer to this, refer to the diagram in your book if you find that easier. You can print this out. You can handwrite it yourself wherever it would be useful. Take a picture of it so you can look at it on your camera, or however you find it easiest to be able to refer to this. And eventually you won't need to refer to it anymore. But when that happens, for some of you, it might be in, next week or the week after. Some of you at the end of the semester might still occasionally want to look at it just to be sure. And if you are not sure, I would encourage you to look at this diagram, because if you get it wrong, it's going to make everything else you do wrong. Okay. So here's my mnemonic, my memory device to help you learn this. So we know this is an equation, right? With assets, the way we typically write it, the assets are on the left-hand side, liabilities and equity on the right-hand side. Yes? Okay. Assets increase on the left-hand side or the debit side. They're on the left-hand side of the equation. They increase on the left-hand side of the account. Liabilities and equity are on the right-hand side of the equation. They increase on the right-hand or the credit side of the account. So you'll notice that liabilities, get my little spotlight here. Liabilities have the plus sign on the credit side. Common stock has the plus sign on the credit side. Retained earnings has the plus sign on the credit side. They're all on the right hand or the credit side of the equation. They all increase on the credit side. You'll notice within the temporary accounts, though, there are two that have the plus sign on the debit side, and that's dividends and expenses. Revenues are just the same as the permanent equity accounts. They increase on the credit side. Revenues increase our earnings. Dividends and expenses decrease our retained earnings. You'll notice they have the minus sign here. They decrease retained earnings, and that's why they have the opposite effect. They increase on the left or the debit side. So the ones that decrease our equity, decrease our retained earnings, increase on the opposite side or the left hand or the debit side. That's the closest I can come to giving you a way of starting to remember this. Think about, where do they appear in the equation? Are they on the left or on the right? And then you just have to remember that dividends and expenses are different because they decrease retained earnings. They decrease our equity. And so they increase on the debit side. This is critical learning. You have to not necessarily memorize it, like I said, but you have to know where to look it up. And that's why I'm suggesting that maybe bookmarking this page is a good idea, as I did here. So let's go to our next exercise. And if you have that available, that graphic I was just showing you, feel free to jump back and forth. We're just going to go down this list and fill in for this exercise the information that we just discussed in that diagram. So all the different types of accounts are listed here. We have to indicate whether they increase or decrease with a debit or credit. And then the new term, the term we haven't seen yet, is this one, normal balance. So the normal balance, and I think I showed you this last week, in Cengage, if you hover your cursor over the colored words, it will pop up a definition for you. So the normal balance is the side you use to increase the account. So assets have a normal debit balance because they increase on the debit side. You can mark that right now. Assets have a normal debit balance because they increase on the debit side. What you will notice is, because of what they've already filled in for us in this chart, we actually don't need to know anything. We don't need to know anything from that diagram to be able to answer these questions, because they've given us something about every single line. So I'm just going to tell you the hint. Whatever you have in the increase column has to be the same as what's in the normal balance column. So assets increase on the debit side, they have a normal debit balance. If they increase on the debit side, they have to decrease on the credit side. So the increase and decrease columns have to have different words, right? One's going to be debit, one's going to be credit. So without even reading what's on the right, what's on the far left, I could just answer all these questions. Well, if any account increases on the credit side, it must decrease on the debit side. And if it increases on the credit side, it must have a normal credit balance. You could do all of that without reading what type of account, but I don't know that that's really going to help you learn anything. So I would like to do them and actually think about it. Liabilities are on the right-hand side of the equation. They have a normal credit balance. They increase on the credit or the right-hand side. So the key here is debit and credit don't mean increase or decrease. They mean left and right. In order to know which side is you use to increase it, you have to first identify what type of account is that. And then we can figure out how it is increased or decreased. Questions so far? If this seems confusing, we're going to keep practicing with it. And I showed you where you can refer to that diagram to look it up. The part you will sort of need to do on your own is looking at the account title and recognizing, oh, that's an expense or that's an asset. Common stock is also on the right-hand side of the equation. So it increases on the credit side. It has a normal credit balance. And if it increases on the credit side, it must decrease on the debit side. I will stop talking for a moment to let you finish those up on your own. And I'm going to put mine on the screen as well. You can use the check my work button once you finish the exercise. Anyone with questions about that? You guys who are on Zoom today, don't forget, if you have questions, you can jump in or post them in the chat. And I'm going to move on to the next exercise. Again, we're not going to do this entire exercise together because it's another one that it's really a multiple choice and you can finish this and check your work and correct any that you get wrong. Looking at the list of accounts, there isn't anything there that is a brand new concept to us, like prepaid expense was in the last exercise. So you should be able to do these on your own with the information you have right now. I'm just going to pick out one, fees earned, and do that one together so you can see what we're doing. So fees earned is a revenue account. That represents the amount that we charged our customers, probably for some service that we provided to them, consulting service, or maybe maybe we're a hair salon and we, did hair, or we're a nail salon and we did their nails or whatever. Those are all services that are provided for a fee. Because it is a revenue account, it has a normal credit balance. On the right hand or the credit side of the equation. It increases our equity. It has a normal credit balance. The rest of these, you should all be able to identify the type of account based on the account title, because those are all things we've seen before. Some include the word expense. Rent and utilities, those are both expense accounts. Accounts payable is a liability. Receivables are an asset. And you should be able to do the rest of those on your own. Any questions before we keep going? Okay. So we're going to start with letter A on the next exercise. And I am going to draw some T accounts on the screen. Whoops. Draw. So letter A says, during February, $186,500 was paid to creditors on account. And purchases on account were $201,400. So I'm going to go a little bit beyond what's in this exercise, so we can think about. Whoops. So we can think about how this works and start to analyze transactions on our own. So when it says that we made payments on account, that means we owed our suppliers and we paid them. I don't know what we were purchasing. I'm just going to pretend that it was inventory. That'll work just fine for our purposes, but the exercise doesn't actually say what we purchased. I'm just making an assumption. Okay. So during February, $186,000 was paid to creditors on account. Well, how do we know that we owed that to them? Because it was in our accounts payable. We had charged it, we had bought on credit at a previous time. So when we make that payment, what do you think we use to make the payment? Cash. So this is the process that you should be following in your head or out loud. Walk yourself through the steps. Eventually, you won't have to think about it in quite such a step-by-step fashion, but definitely to start out, you know, for this chapter, for the next couple chapters, I want you to think about every single step. So cash was affected by this transaction. We know that all transactions have to affect at least two accounts. In this one, cash was one of them. Did our cash go up or go down? Down. So I'm just going to label these. And again, for the next little while, but not forever, I will label the accounts like this just to help us remember. So I'm labeling the debit and credit side. And the other thing I'm going to do is for each one of these accounts, I'm going to put in the plus and the minus. So cash is what type of an account? Asset. Because it's an asset, it increases on the debit side and decreases on the credit side. How about accounts payable? What type of account is that? Liability. So liabilities are on the right hand or credit side of the equation. So I'm going to put the plus on the credit side and the minus on the debit side. And how about inventory? Asset. So just like cash, it will increase on the left or the debit side and decrease on the credit side. Feel free, if you're drawing this out, if you are working in a notebook and writing these out to help you remember to see what happened, feel free, as long as you need to, as long as it's helpful, to put the labels, the debit and credit and the plus and minus. Because in the long run, that will help you to remember, and it will also make doing the exercise faster, most likely. So we said that we used cash to pay those creditors. So to show that we have less cash, we're going to report the number, the dollar amount, $186,500 on the credit side, on the side that has the minus, on the side that we use to decrease that account. You'll notice I didn't put a dollar sign. It's actually not correct to use dollar signs in T accounts. We have, as you should have read in chapter 1, we use the concept of money measure when we're doing our accounting. And because we are in the United States, we're going to use dollars to denominate our transactions. It's understood that that number is a dollar amount. So it's not correct to use a dollar sign in a T account. So what's the other account that was affected? We don't have that money anymore, but what else was affected? Accounts payable. We don't owe our suppliers anymore, at least not for this amount. And so in our accounts payable, we're going to report that also on the side with the minus. We want to reduce our accounts payable. Our liability is lower because we just paid a whole bunch of bills. So our liability accounts payable is going to go down. What you will notice, as I've already mentioned, every transaction has to affect at least two accounts. And every transaction will have at least one debit and one credit. And in total, the debits and credits have to be equal. When we have a transaction like what I just recorded here, where we have one debit and one credit, that's called a simple transaction, and the dollars on both sides are the same. Sometimes we will have transactions that affect more than two accounts. Again, there always has to be at least one debit and at least one credit, but there could be 3 debits and 7 credits. That would be kind of weird, but it could happen. There could be more than one debit and or more than one credit. And if that's the case, we have to add up all the debits and we have to add up all the credits and make sure that in total they're the same for that transaction. As long as every transaction you record has equal dollars on the debit side and the credit side, the whole system will stay in balance. Our equation, assets equals liabilities plus equity, will stay in balance, and we'll be very happy about that. So you want to check for each transaction, make sure it balances, make sure your dollars debited and credited are the same. Everybody okay so far? What's the next thing it tells us? Purchases on account were $201,400. And I already said, I'm just going to assume we were buying inventory. It doesn't tell us, but we'll pretend. So when we bought inventory on account, what's one account that's going to be affected? Accounts payable. Is it going to go up or down? It's going to go up. We bought on account, so now we owe our suppliers a little bit more, a lot more than we owed them before. Okay, so we can't have a credit without the debit. What's the other account that's affected here? Inventory. And do we have more inventory? Yes, we have more inventory. So we're going to report that same number on the debit side, or the side of the inventory account that has the plus sign, the side that we use to increase inventory. So again, we have a simple transaction, a debit to inventory, a credit to accounts payable for the same amount. Okay. They then tell us, assuming the February 28 balance of accounts payable was $59,900, determine the account balance at the beginning of the month on February 1st. So we need to know how to find the balance in these accounts. I'm going to draw a line there to represent that we're going to total those accounts. And what we were told was that the balance at the end of the month was $59,900. The balance, it doesn't tell us whether it's a debit or credit balance. And since it doesn't tell us, we are going to assume, it's safe to assume that the balance is whatever the normal balance for that account is. Accounts payable has a normal credit balance. And so I'm writing that balance at the end of the month down at the bottom. I should have given myself just a little bit more room here. I'm going to sneak in an extra line right there. I'm going to be crowded in a little bit here, so just bear with me. To balance an account, we add up all of the numbers that are on the debit side, and we add up all the numbers that are on the credit side, and we record them at the bottom of that column of numbers. It's called the footing of the column. Just like your foot is at the bottom if you're standing, the footing is the total of all the numbers, and we record it at the bottom. So I am going to record 186,500 there as the debit footing. But what I don't know is, I'm just going to put a question mark here. What I don't know is what the beginning balance was. It's some number, easier if I put a box here. I'm going to put some number here that is the beginning balance for accounts payable. That's what we are asked to find. Is this a realistic scenario that we would know the ending balance if we didn't know the beginning balance? No. But it's to help you see how the numbers make sense. help you understand where the numbers come from. So back to balancing our accounts. We find the debit footing, which we already found. We find the credit footing. Well, I can't find the credit footing because I don't know what the beginning balance was. I'm going to put question marks there too. I have to find that credit footing. Once we have that credit footing and the debit footing, we compare them and we determine which number's bigger. And then we subtract the smaller number from the larger number and we record what's left on the side, the difference on the side that had the larger footing. So the fact that I recorded 59,900 on the credit side tells me that the credit footing was larger, and it was larger by about $60,000. So to find that credit footing, I'm adding together the ending balance, 59,900, plus the debit footing, and I'm just going to write that right here. And then I'm going to do what I think of as a reasonableness check, and this is something you might be asked to do in a math class. Does that number even make sense? Well, let me put this in real terms for you. That 246,400 credit footing, what that means is during the month at some point, we owed our suppliers $246,400. And then we paid off $186,500. So does it make sense if we owed about 246 and we paid off about 186 that we'd still owe 60,000? That makes sense. And so I'm pretty confident with my numbers. Now we have one more step. If we owed 246,400 throughout the month, and 201,400 of that was new purchases during the month, how much must we have owed at the beginning of the month? How are we going to find that? We're going to subtract 246,400 minus 201,400 is $45,000. So the answer to letter A is $45,000. And if you're still really not sure, talk it through and see if it makes sense. We owed 45,000 at the beginning of the month. We bought another 201,000. So we owed about 246. We paid off 186. We still owed 60. Yep, that all makes sense. All the numbers, even though I'm rounding, all the numbers make sense. And so I'm pretty confident that we've got the right answer. Does everyone see what we're doing? Does it? Anybody want to ask a question? I'm going to erase what I have on the screen so we can work on part B. On October 1st, the accounts receivable balance was 115,800. During October, we collected from some customers, and then we have our ending balance. And we're asked to figure out how much we billed to our customers during the month. So again, I'm going to put in 3 separate T counts. If you're taking notes, you can certainly put these in your notes. I'm going to do the same thing I did on the last one, which is have my fingers on the wrong keys, apparently. So cash account, accounts receivable. I'm just going to make this a little simpler, and I'm going to use the common abbreviation for accounts receivable, which is A/R. Accounts receivable is typically abbreviated as A/R, AR, and accounts payable then would be abbreviated AP. So why do we have accounts payable? Because our customers bought something from us and they haven't. Why do we have accounts receivable? I think I may have said the wrong word. Why do we have accounts receivable? Because our customers bought something from us and they haven't yet paid us what they owe. It's a receivable, it's an asset. And just like we did through the last exercise or the last part of the exercise, cash is an asset, so it increases on the debit side. Accounts receivable is what type of account? Asset, so it's going to increase on the left or the debit side. And how about revenues? I'm not sure. It is a stockholders' equity. It's one of those temporary stockholders' equity accounts. Increasing revenues increases our equity, and so it has a normal credit balance. And I apologize to whoever answered first. I didn't quite catch what you said, so I didn't want to put words in your mouth. And so just for the sake of this exercise, because we're just learning, I wanted to show you, again, we're going to analyze the transactions that it tells us and then figure out what's missing. So I'm doing a little bit more in this exercise than probably you technically need to do to answer the question, but I want you to be thinking about everything that's happening, not just the one account that they're asking about, which is accounts receivable. So they tell us the beginning balance in accounts receivable was $115,800. We already said accounts receivable is an asset. And that means it increases on the debit side. So when it tells us that the balance is 115,800, we can safely assume that's a debit balance, that it has its normal balance. And if it had something other than the normal balance, it would tell us. During October, $449,600 was collected from customers on account. Collected from customers. So what do we have now that we didn't have before? A whole bunch of cash, right? We have a whole bunch of cash that we did not have before. So in our cash account, would we record that on the debit or the credit side? Do we want it to go up or go down? We want it to go up, and so we would increase it, or we would record that number, 449,600, on the debit side. Now we already know that we can't be done with that because if there's a debit, there has to be a credit. And so what else changed here? We collected a bunch of cash, but what else happened? Exactly. Our accounts receivable goes down because our customers no longer owe us that money. I knew it was going to go on the credit side for a couple different reasons. One, because I already had the debit. I know I'm looking for the credit. But two, accounts receivable has a negative sign on the credit side. So if I want my accounts receivable to go down, I know I need to record that number on the credit or the right-hand side. Then it says, excuse me, assume the October 31st balance was $130,700. Assume it was $130,700. So I'm going to now, this time, I'm going to give myself a little bit more room here. And I'm going to put a line there. And then I'm going to put another line here. Ignore the fact that they're not quite the same length. Drawing with the annotate tools in Zoom is not a precise science. So it tells us, again, that the balance is $130,770. Doesn't tell us whether that's a debit or a credit, but we are going to assume, whoops, sorry, not where I want to be. We are going to assume that it is the normal balance, because it would tell us if it wasn't normal, if it was abnormal, it would say it's a credit balance. So we can safely assume it's a debit balance. And what it asks us to determine is the fees billed to customers. So when we perform a service or sell a product to our customers, and they agree to pay later, the entry looks like this. God bless you. We are going to credit revenues because revenues increase on the credit side. When we earn some money from our customers, we want to increase our revenues and we record that on the credit side. But they haven't paid us yet. And so they owe us that money, and that's going to increase our receivables. If they paid us at the time we performed the service, we would have debited cash and credited revenues. But because they bought them, whatever services or product we were selling, because they bought it on credit, our receivable goes up at the same time as the revenues. And so where I have those boxes, we're looking for the number that goes in those boxes, and it will be the same number in both accounts. So just like we did in the last exercise, we now, part A, we now have to find our footings here. And to find the debit footing, so we have the credit footing, we don't know the debit footing because we don't know how much was billed this month. But we do know how to balance an account, and we know that we took this number, whatever is going to go right here, and subtracted the 449.6 to get the 130,770. So to find out what goes here, again, I'm just going to add those together, just like we did in part A. 130,770 plus 449,600 is 580,370. And now we can find the missing number because we know in total during the month, we were owed $580,370. And at the beginning of the month, they already, our customers already owed us $115,800. So must be during the month, we sent out bills, we performed services or sold product worth $464,570. And so the answer to this question, part B, 464,570. And as I already said, I would encourage you, once you find the answer, especially when like this, they kind of have you doing things in a convoluted order, not the way things would really happen. I would encourage you then to just walk through it and see, does that make sense? So let's talk about what happened here. I'm just going to round off. At the beginning of the month, our customers owed us $116,000. They bought another $464,000, but they paid off about $450,000. So they charged $464,000 and paid off $450,000. So our ending balance should be about $14,000 higher than the beginning balance because they charged more than they paid off. So 130 for the ending balance makes sense with the beginning balance of 115 and the new purchases of 464 and the payments of 450. So seems like that all fits together, makes sense. Questions so far? The more we do this, the more we talk about it, the more it's going to kind of click for you. So if right now you're thinking, yeah, it makes sense when you say that, but there's a lot to that. There is, but we're going to keep practicing with it. That's why it's important that you keep up with what we're doing in class. Excuse me. And clear those drawings. And let's look at part C. So for part C, I'm only going to draw one T account. Oops. Let me draw one T account, which is the cash account. And just to make things clearer for us, I'm going to continue, as I said, to label this debit and credit side, and cash is an asset, so it increases on the debit side and decreases on the credit side. It tells us that at the beginning of the month, the balance was 46,220. Well, we know that cash is an asset. We already established it has a normal debit balance. So if it tells us the balance is X, we can write that number on the debit side. During April, we collected or we received cash for some reason. Doesn't say what these cash receipts were for, and that's why I didn't put any other T accounts. This is just kind of a collective number. We may have received cash because people paid their bills. We may have received cash because we sold some more product for cash. It may be that we got a rebate from one of our suppliers. I don't know, there's any number of reasons we might have received cash. But collectively, we received $248,600. And so I'm going to write that on the debit side because we received that, it increased our cash. And then it tells us that the ending balance in our cash account was $56,770. And it wants us to figure out how much we spent. So we know what we started with, 46,220. We know how much we added to it, 248,600. What we need to find then is the number that goes right here. How much did we spend? So I'm going to ask you to try this on your own. Find that number, knowing what we already know about how to balance the accounts. And so how did I get that number? Well, I knew that in total, not necessarily at any one point, but throughout the month in total, we had $294,820 in our cash account. How did I know that? Well, I know what we started with and I know what we added to it. So we had a total of $294,820 available throughout the month at various points. And we only had $56,770 left. So I subtracted that ending balance from the debit footing. And I know that must be how much we used out of the account, $238,050. Okay, so this is our first experience really of analyzing transactions, of thinking about how the transaction looks. That is, knowing that there has to be at least one debit, one credit, at least two accounts involved in every transaction. Anybody with questions so far? We will keep going then. So I just want to point out to you that exercise 5 goes with exercises 9 and 10. So we're going to be doing, with the 15 minutes we have left, we're going to do a little bit of jumping around between those three exercises. And then, as you know, So that's going to use up the end of our time for class. As you know, next week you'll be able to watch the recording and work on the remaining exercises. And I will include in the announcement if there are any exercises that are the same, but with different numbers, just so you know to be careful about that. So let's look at exercise, what number is this? Exercise 5 next. Crazy Mountain Tours Company is a travel agency. The 9 transactions recorded by Crazy Mountain Tours during May 2022, its first month of operations, are indicated in the following T accounts. So you can see that cash has a whole lot of transactions in there. Not surprising, we use the cash account more than any other account that's involved in a lot of our transactions. You'll also notice that these accounts, many of the accounts have only 1 or maybe 2 transactions in them. This was a brand new company, first month of operations, and so none of these accounts had an opening or a beginning balance. But after the first month, any of the permanent accounts would carry a balance forward. In other words, whatever we have in our cash account at the end of May is also going to be how much we have in our cash account at the beginning of June, right? We don't have to start over from scratch at the end of every month. Some of these accounts, dividends, revenue, and operating expenses, those accounts are temporary accounts and they get zeroed out at the end of each month. And in chapter 4, we'll see how we do that. But what we're asked to do here, and apparently I made to make this just a little bit smaller so it fits in. What we're asked to do here is look at each account and talk about what happened. So normally when we do a transaction analysis, when we analyze a transaction, we would indicate the date that it happened. As I said, there are really 3 questions we have to answer when we are analyzing transactions. So before we analyze the transaction, we first have to decide, is this a transaction? If we say, yeah, it's a transaction, then we have to answer 3 questions. And the 3 questions are recognition, valuation, and classification. Recognition means what date do we put on it? Valuation is what are the dollar amounts involved? And classification is which 2 or more accounts. So we know every transaction is going to affect at least 2 accounts, and it could be more than that. So once we know it's a transaction, we have to answer 3 questions. What date, what dollar amounts, and which accounts are affected. In these T accounts that we have here, where they have the numbers in parentheses, 1, 2, 3, 4, 6, 9, 7, those are the 9 transactions. And normally where those numbers are indicating the transaction, normally we would have a date there. So we have a number 1 here. Oops. We have a number 1 here, a debit to cash for $50,000. We know there has to be a credit that goes along with that transaction, and I found it right down here in common stock. So we have a debit to cash and a credit to common stock. What happened, do you think? That's the very first transaction this company engaged in when it started business. Okay, so yeah, so we established ownership in the company. Okay, we sold stock. We now have $50,000 in cash we did not have before, and we have $50,000 in equity, which represents the ownership stake of whoever owns this company, and it doesn't tell us who that is. Could be a bunch of different people owning that stock. It could be all owned by one person. So the account that was debited in that transaction was cash. Cash is what type of account? Asset. And because we debited an asset account, did it increase or decrease? increased. We have $50,000 more in cash than we had before this transaction occurred. The credit side was to common stock, and that's what type of account? Yep, stockholders' equity. And crediting a stockholders' equity account causes it to increase. It's on the right-hand side, it increases. Does that make sense? Okay. As I said, I'm going to jump around a little bit. I want to go ahead now to exercise 9. It's exactly the same information, and what we are asked to do. Oh, no, sorry, I can't. That's not the one I wanted. 10 is what I wanted. Sorry, go to exercise 10, please. So exercise 10 gives us exactly the same information. Exercise 9 does too, but that's not what I wanted to do yet. Exercise 10 asks us to actually prepare the journal entries. A journal entry is how the information gets into our accounting records. And so what we've been doing so far is talking about what the transaction would look like, which accounts, which amounts, but the journal entry is actually what we do in our accounting records to get the information in there once we've analyzed it and we know what date, what accounts, and what amounts. I'm going to refer you again back to our reference materials in Brightspace. And we were just looking at the first one. I'm now going to the second entry here, required form for a journal entry. So this is right. So this is right at the top of the reference materials folder, and it tells you, it shows you what a journal entry is going to look like. It includes the answers to those 3 questions that I just wrote on the screen, the 3 questions we have to answer. Recognition, what date goes on it? We have right here, the date. Oh, that gold didn't work very well, did it? Right here, we have the date. Now for our exercise, we're just using the number 1 for the first transaction, but in a real situation, it would say May 1st or May 27th or whatever date it was, okay? The second question is valuation, which dollar amounts. And so you can see here the dollar amounts. 1 in the debit column, 1 in the credit column. And we know if it's a simple transaction that has just 2 accounts, those amounts need to match. They're going to be the same number. And the third question is classification, which is what accounts are we using? And you can see here, we have spaces to write 2 different account titles. We always write the account that's debited or accounts that are debited, always are written first. And then you indent, you can see that that's indented right there. And then we write the accredited account title or titles. In a simple transaction, we have just 1 of each. And so again, this is in the reference materials folder, and I would encourage you to refer to it, to remind you of what needs to be included there. So, and I'm going to go back to our exercise. So you can see in the exercise, they've already set up that field for you to show us what it's going to look like. And we're doing the journal entry labeled number 1, transaction number 1. As we saw in exercise 5, it included a debit to cash for $50,000 and a credit to common stock. So the number 1 represents the date. We list the debited account or accounts first. So which account did we debit? Cash. And how much did we debit to cash or add to our cash account? 50,000. You don't need to put in dollar signs. Dollar signs do not belong in journal entries. For our software, you don't need to put in the commas. It will put the commas in for you. And next, we're going to see something that I think is really cool about this software. So what was the credited account? Common stock. So I'm going to pick common stock from the list. Now, that list, you'll notice, didn't have all of the accounts that we have available to us, all of the accounts that are used here. I don't know how many there are, 7 or 8 different accounts that we have there. The list didn't have all of them, but if this was a real accounting situation, that list would show all of the accounts that are in the chart of accounts. Here's the cool part. How much did we credit to common stock? 50,000. So as soon as I enter a number in that credit box, the software indents it for you. I'm pointing that out because the required form of the journal entry does include the credited accounts being indented. The software does that for you so that you can see, oh yeah, that's what it should look like. Debited accounts listed first, and then we indent and list any credited accounts. And we can see that the dollar amounts that we debited and credited are equal. Make sense? So let's go back to exercise 5. And obviously we are about to run out of time. So I want to do just the next transaction in this exercise, in exercise 10. And then you'll be able to watch the video. I can't remember, not surprisingly, I can't remember from January exactly where we ended. So you've got 2 videos from chapter 2. We're about at the start of the second video. So you may need to fast forward a little bit into day 2 or watch the very end. I'll take a look later today, and I'll try to put that in the announcement. Let's look at transaction 2 here. Includes a credit to cash for 4,000 and a debit to operating expenses for 61.75. So there must be another part to that. Whoops, that's number 4. Hang on. Sorry, got carried away. Number 2, a debit to supplies for 4,000. So the debited account was supplies. What type of account is that? An asset. Since we debited that account, the asset was increased. And the credit was to cash. That's what type of account? An asset. And when we credit an asset account, it goes down, it's decreased. Yep. And then down to number 10, exercise 10, we need to do the journal entry for that same transaction. Now, obviously, when you're doing the rest of these on your own, if you find it easier to do all of exercise 5 and then do exercise 10, that's fine. Yes, sir. Can I explain what happens? Yeah. Yep. So let me just put this one in quickly here. So debit to supplies, credit to cash for 4,000. And exercise number 3. So we've got, whoops, we have a right there. We have a credit to cash for 10,000. Okay, so this is a compound entry. So we have a debit to equipment for 30,000. What happened there? Did we increase our equipment? Yeah, so we must have bought some equipment, right? So we increased it. But how did we pay for it? Well, we put a down payment of 10,000. We used 10,000 in cash. And here's the rest of it. The other 20,000 is in accounts payable. So we paid $10,000 down and we agreed to pay for the rest of it at a later date. Maybe we were paying 10,000 next month and the month after, I don't know. And so on the exercise here, we credited the cash account, that's the asset, and used some cash, so it went down. But we also credited accounts payable, which is a liability, and so we increased that liability. And so the reason it has the two lines is because it was a compound transaction. There were actually two different accounts that were credited. The dollar amounts are the same though. 30,000 in equipment, debit, 10,000 in cash, 20,000 in accounts payable on the credit side. So the dollars in total are still the same. And that's our first compound transaction. I have zero time. Oh, it's gonna actually sign me out. Let me just tell you, for exercise 9, it is the same transactions, same T accounts. But what you need to do is balance each one of those accounts. So you've seen how to do that. The cash one's the hardest, of course. And you're going to put them into this unadjusted trial balance. So find the balance in the cash account and record it here. Find the balance in accounts receivable and put it here. They should be listed in that order we already discussed. Assets, most to least liquid, liabilities, short-term to long-term, permanent equity, dividends, revenue, expenses. Okay, thank you for being here, and don't forget, while I'm gone, you're welcome to send me emails, but I almost certainly will not be able to reply to you until I get back on September 11th.